Senator, I guess this is really your first crack at the Fed chairman since this more dovish stance that we've seen. What questions do you have?
Well, I think really two categories, Becky, for me. One is I'm looking forward to continuing the discussion with the chairman about the Fed's balance sheet. How quickly is the runoff going to proceed? At what point does this runoff end? I think the chairman is likely to explain that the balance sheet is not going to go back to pre-crisis levels, even as a percentage of GDP, not in the foreseeable future, because banks' excess reserves deposited with the Fed just leave them with a bigger balance sheet than they otherwise would have had. And those excess reserves are, of course, a function of liquidity requirements. So I'm looking forward to hearing him walk us through that. What is the terminal point where excess reserves become too scarce and they can't reduce the balance sheet further for that reason? How do they control monetary policy in that environment? I think he's going to say it's by changing the interest they pay on these excess reserves. I also am hoping that we will find a way to continue to run off the mortgage-backed securities. I think it was always a bad idea for the Fed to invest in anything other than treasuries. So a lot of discussion, I think, around the composition and the size of the Fed's balance sheet. But the other interesting topic, as you know, is this discussion within the Fed and beyond as to whether the Fed ought to really be targeting the change in the overall price level or the price level itself. In other words, if we go for an extended period of time where the inflation rate is below a target, should they intentionally overshoot the target for a subsequent period so that the average reaches the 2% and you're really targeting a price level? I don't think the Fed has adopted this approach, but they're certainly discussing it. It seems to me the inflation demon has broken out of the cage many, many times throughout history and wreaked havoc. I would like to hear a discussion about why we should be confident that we can manage it with that level of precision. But I think that'll be an interesting topic of discussion.
Hey, Senator, that's really refreshing. Obviously, you know a lot about this. You are very steeped in the fine details that go into this, and that's not always what we anticipate. Obviously, he's lucky to be going before the Senate first to really get into that. What kind of questions do you anticipate that he might get that might be a little more controversial in terms of, is there still this controversy swirling around the Federal Reserve, its powers? Are there still people either in the Senate chamber or over in the House who really question whether there should be a Federal Reserve at all?
Yeah, I think that's a very, very, very small minority view. I think the overwhelming consensus accepts the idea of an independent central bank. Now, how independent, how quickly should we get a look at the minutes of their meetings? What's the nature of the audits that ought to be required? Those topics around the edges are certainly topics of conversation. Look, I've got friends that seem to take every one of these discussions to the question of income inequality, and so I imagine the chairman is going to have to field some questions about that. Of course, he'll get questions about the strength of the economy and the outlook. And
well, let me ask you about that in particular. Because the Fed has now gotten more dovish, do you have questions about what he sees in the economy? Do you have concerns about what he sees in the economy as a result?
So I'm not that concerned about that. First of all, I give this chairman a tremendous amount of credit for the normalization of monetary policy that he really has largely achieved. At least we've gone a very long way in that direction. It looks like, with hindsight, certainly the December rate hike was a mistake. I think they got that. I think they've changed their path somewhat. Now the market expects what? Most likely no interest rate increase at all this whole year. Maybe that changes. But I don't think it's because they think the economy is fundamentally weak. I think it's because they realize there's no inflation out there. The Phillips curve has lost its predictive value, if it ever had any, which I've always been skeptical about. The fact that we have low unemployment does not mean that we have high inflation. And so they don't have to choke off a recovery here when there's no sign of inflation. So I give them very high marks for, generally speaking, how they've been managing our monetary policy.
In terms of what's to come, are you going to be questioning very specifically about what it would take to see him actually start to say it's time to raise interest rates again? Because most of the market is assuming right now that they are not going to be doing that for the next 4 to 6 months.
Yeah, you know, to the extent that he can, I think he'll give us very vague and general ideas about that. You know, I'm a little bit more interested at this moment in sort of the mechanics of the size and the composition of the balance sheet and whether they think they ought to change what they're targeting. But you know, for now, it looks like they're in kind of a wait-and-see mode, looking at the data as it's coming in. And, you know, the data looks like reasonably strong economic growth and inflation that's pretty tame. So I'm not sure there's a need for them to do much different right now.
Senator, you know, I don't know what next year's GDP looks like, but people are ready to pounce on if it goes back to where we've been in the past 10 years or so. People are going to say that that was a one-shot deal, that it was just the Republican version of the $800 billion that we blew in, you know, on shovel-ready projects, just another Keynesian near-term stimulus. What do you think it's going to be, GDP next year? And if it is back down to 2.25, was that all for naught? It didn't really change the incentives for corporations to invest and permanently raise the average GDP rate?
So we know for a fact that we increased incentives to invest. I mean, that's just arithmetic. That you have a better return on invested capital post-tax reform than you did pre-tax reform. All else being equal, that has to enhance the incentives. But look, we're in a dynamic environment, right? There's a global slowdown, certainly in growth. Europe is barely growing. China, who knows what they're doing, but it sure isn't booming the way it once was. We have trade friction and tension that while it's probably tariffs are small as a percentage of GDP, they probably are casting a bit of a shadow. And we did just go through this normalization of interest rates, which took us from basically zero to what looks like it's probably closer to what is now normal. The combination of those things could create a little bit of headwind, but I still think we've gone a long way in having a more rational tax code, restoring incentives where they should be, and all else being equal, that's going to lead to stronger growth.